Hello everybody, I hope you're all doing well. Thank you for tuning into this video. Today I'd like to talk about basically higher time frame mitigation and lower time frame execution. So to get things started here, we're taking a look at GBP JPY on the 15-minute time frame. And I don't have anything marked up just yet, so I'd like to go through everything step by step with you all. So by looking at this at first glance, there's not too much that stands out. Typically, I start from the higher time frames and work my way down, right? So on the 4-hour time frame, we're seeing that there's some bullish intent coming into the market. We've recently broken this high, right? Created a break of structure to the upside. On the 1-hour time frame, we're just seeing that bullish order flow continuing. So there's a potential bearish to bullish reversal going on here. But back to the 15-minute time frame. Let me see here. So as you can see, we've got relative equal highs right around here. That can represent a lot of liquidity resting above there. So although we haven't seen a full break of structure in a swing perspective, like a swing high taken out, which would be this right here, because of that resting liquidity up there, I would still be looking for bullish order flow continuation trades here. So that's what we're going to go over today. Now, I want you guys to focus on this area right here, okay? Because we had a clear consolidation, right? Very clear choppy price action. And then bullish volume came into the market and created this massive candle here, creating a lot of imbalance and inefficiency in price action. Now, since that happened, we can see that price did make its way back down and cleared pretty much all of the imbalance, right? There is still some left between this candle and this candle. There is still imbalance and inefficiency there. So there's a good chance that price will come back down to this general area of consolidation to mitigate any open orders before continuing hopefully to the upside, right? To clear the resting liquidity, to clear the resting liquidity above these highs here. So we've covered that the bias so far is bullish, right? So now what we have to do is identify a point of interest. Now, keep in mind, like I said, this was the consolidation here, and then we had an injection of bullish volume into the market. So what was the point of origin for that? I'm going to give you a second to just take a look at this. Man, what is going on with my mouse? I'm going to give you a second to take a look at this whole phase right here and try to identify for yourself the point of interest that I'm most likely going to be highlighting. So let me bust out the rectangle tool, and I'm going to highlight this small bearish candle that was printed on the chart right before that massive bullish full body candle. I'm going to just drag it over to the right. So that's my point of interest. The reason being, as we've gone over in previous case studies and course videos, that is the point of origin for the bullish move. Okay, it was the last point of demand prior to the bullish volume coming into the market and breaking out of this consolidative phase. So there's something else that I want to go over that adds confluence to this being a valid point of interest, and that would be resting liquidity once again. So as you can see, right here we have relative equal lows here as well, but I'm just going to focus on these two for now because they are relative equal lows, and most retail traders would look at this as a double bottom buying opportunity, which means it represents a lot of liquidity. Let me just add that on. I just put the little dollar sign there just to represent that there's a lot of stop losses around that level. Now the reason that would be a very liquid area is because most traders would be looking at it as a double bottom or support, and they would be placing their stop losses, or sorry, they'd be placing their orders in a similar way to this, right? Maybe even like a 10 pip stop loss, 8 pips, 9 pips, something like that, slightly below this level, but there's going to be a lot of entries placed at this level in anticipation that it'll be a double bottom. Now, the sad part is most of those traders are correct on the bias, but of course, incorrect on the timing and placement of their trading parameters, their position parameters, should I say. So that's the sad part, but you know, luckily for us, we understand these things and we identify liquidity before we become part of the liquidity. So having that resting liquidity there it adds validity to this point of interest because we know that price is going to be drawn to this area like a magnet to purge the resting liquidity from these lows here, trade a bit lower, mitigate the actual last point of demand that caused this move. And then once those things occur, price is free to flow in whichever direction it chooses, right? But this is something that needs to happen. So that adds validity to our point of interest. So let me play price forward and we'll see how this pans out here. So what I'm looking for is for this area to get mitigated. And of course, like I said at the beginning of the video, we're focusing on low time frame executions. So once we tap into this higher time frame zone, then I'm going to drop down to a lower time frame and we'll see if there's any trading opportunity for us. Now, although I'm on the 15-minute time frame, I just want to clarify something before we move on. This can still be considered a higher time frame if you're going to be executing on the lower time frames like 1 minute, 3 minute, 5 minute. So the terms low time frame and high time frame, they're very relative, right? They're very subjective because it just depends on your style of trading. Let's say I was a very long-term swing trader and I utilized the weekly time frame, the daily time frame, etc. Then technically the 1 hour and the 15-minute would be considered low time frame for me, right? So if I'm executing on the 1 minute and 3 minute and 5 minute, then higher time frame could be 10 minute, it could be 15 minute, 30 minute, 1 hour. It could be any one of those and it's still considered a higher time frame in comparison to the time frame that I'm actually planning to execute trades on. Okay, so in this example, the 15 minute is the higher time frame. That's where I located this point of interest. And this is the area that I'm wanting to see price mitigate before dropping down to a low time frame and looking for a confirmation model for entry. So let me play price forward. Okay, so right here, we obviously cleared that liquidity below those lows, price traded below it, and we've now mitigated this order block, okay? This demand zone, the last point of demand before the bullish injection of volume. So now that we've tapped in there, we're going to drop down to the 5 minute time frame. Okay, so nothing yet on the 5 minute. Let me go to the 3 minute because I'm trying to identify the first change in this trend. Basically, I want to see a structure change, even if it's just minor. So there is a minor structural change there. We see clear bullish volume. Let me just drop to the 1 minute real quick too. Okay, so technically this is the first sign because, let me just get out the brush tool. We had a high, price traded lower, solidified this low when it retraced. We had another high, broke the low, created a new low. And from that point on, we saw a bullish engulfing candle, which created a lot of volume, breaking this high. Okay, so that is the first change in our market structure. Let's see, let's delete that. Let me go back to the 3 minute time frame. We'll play price forward a little bit. Okay, so now that we're consolidating again, that's showing me that we have a solidified high once more. So this would be the area that I'd like to target for a possible entry because we do see that first sign in bullish order flow, which is validating our overall point of interest, right? So if I wanted to stay on the 1 minute time frame, I could target this order block here, but I don't think I'm going to do that. That's just a little bit too refined. Let's see. Okay, so to keep things simple, let's stick to the 5 minute time frame. Let's stick to the 5 minute time frame because this is a clear order block. Right, so we'll drag that out. Let me rein this back a little bit so it's out of our way. Okay, so we're going to place our first entry on this zone, right? So we have the higher time frame mitigation. If we just quickly jump back to the 15 minute, the price has tapped into our point of interest, our POI. And now we're sitting on the 5 minute time frame looking at this as our new refined point of interest, okay? Because this is the order block that was responsible for this new volume that's coming into the market that will represent a potential higher time frame continuation of bullish order flow, but now our lower time frame is getting in line with the higher time frame bias as well. Okay, so that's really important. When they line up, that's when the trading opportunities present themselves. So let's set up our position tool. Let's go for the top of the zone. What kind of stop loss can we get here? Let's go 8.5. And for this, we're simply going to target the most recent high. So this position represents about 7.15 R. Let's play price forward. Okay. So technically right there, we got tapped in. All right, so before I continue, we've tapped into our first trade here. Very little drawdown. We mitigated this refined order block, which was part of our higher time frame point of interest. This is our new refined point of interest, right? So we've mitigated that. We're active in this trade now. And the structure that I'm looking at now would be this high here. So if price can continue bullish, as of now, it has broken that structure, but let's see if the next candle closes above as well, which would represent a very strong, clear break of structure. And then we could potentially look at another trade to get into. Okay, so we do have the clear break of structure there. Now, let's see. Okay, so technically, yeah, the break of structure did occur there. There's no clear order block here. I would like to target, for a scale-in trade, I would like to target this area here because that was responsible for the break of structure, okay? So let's highlight this one here, this bearish candle. And we can go ahead and place another entry here. Remember, I'm targeting that candle because it was the last point of demand prior to this break of structure. This big bullish candle here, this was the low volume candle, the last point of demand prior to that move. So let's see how we can arrange this. We could go with 7 pips as a stop loss just to clear the low of the candle. Target the same area. What is that? 154,718. Okay, so that represents basically 7.25 risk to reward ratio. Let's drag these out a bit more. Right, so we've got one position active, another potential stacked position set up. Let's see if that gets triggered. And it does. Okay. Let's clean this up a little bit. All right, so as you can see, we're just simply following structure now. These are continuation trades. So let's continue this a little bit more. Okay, and we see another break of structure. Right, another clear break of structure here. Let me label that on. Okay, so what I want to talk about before I continue is sorry, 1 second here. Let me just give it some room, clean things up a little bit. All right, so we got into the first position. That could be considered an aggressive entry. The reason being, it's the first step of the confirmation model, right? So as you guys know, the confirmation model consists of 2 break of structures. And the safest way to enter is upon the second break of structure, which we now have, right? We now have, well, technically, there was a minor break of structure within here, and that's why we got into the first position. So this was the very aggressive entry. Then we saw this second break of structure, which makes this a point of interest. And so this would be the safer entry. So if we just hide this for a second, technically, this is the safest way to enter upon the confirmation model. So we have the higher time frame zone which got mitigated. So higher time frame mitigation, low time frame execution, right? So this would be the safest way to enter the confirmation model. But in my opinion, it's good to do both aggressive and conservative ways of entering the confirmation model. What you can do is split your risk. So instead of doing 1% full risk, you could do 0.5% on each, because oftentimes we won't get the second confirmation. It happens quite often in my trading, especially. I noticed this. Like, I've been getting in on the more aggressive entry as soon as possible, because oftentimes we won't see a clear mitigation of the second break of structure to get in on this next safer position. So it's good to enter both if you can, with reduced risk. But just keep in mind, the first one is very aggressive. The second one is a little bit safer, right? Because once we've seen 2 clear breaks of structure, or even 1 minor break of structure and a proper break of structure, that represents a true change in the trend, right? A minimum of 2 structural breaks is what we use to identify where the trend is going. So if we only have 1, then it is a bit speculative and aggressive to enter upon the first minor break in structure. So with that being said, let me just play this forward and see where this ends up. Let's speed this up a little bit. All right, so yeah, did that hit the take profit? Okay. So as you can see, both of these trades hit take profit. Which of course is a combined total of just under 15R, which is fantastic, considering these 2 trades only took 9 hours to play out. So that's phenomenal. You could probably take the rest of the month off at that point. It just goes to show how powerful this strategy truly is. But the main point I wanted to drill here is that there's an aggressive version of this entry and a more conservative version of this entry, and both are good to take, but you have to understand the difference and the risk associated with each of them, okay? So just to sum this up, we had on the 15-minute time frame a point of interest, a demand zone that was responsible for this injection of bullish momentum that created imbalance and inefficiency within the market. Now, our point of interest zone here was considered even more valid because we had this resting liquidity. So we know that there's a very, very high probability price will want to purge that liquidity and then mitigate any demand just underneath it, which is exactly what it did. Now, instead of taking a risk entry just based on this higher time frame 15-minute zone, what we did is, as soon as price tapped into the zone, we dropped down to a lower time frame, the 5-minute time frame, and we looked for the confirmation model. So the first minor break of structure was more visible on the 3-minute and the 1-minute. Sorry guys, my chart's being really slow right now for some reason. So the first minor structural changes were more visible on the 1-minute and the 3-minute. As you can see, we broke this minor high right here, which would prompt me to target this entire zone. And as you can see, now that we're back on the 1-minute time frame, if I just targeted this order block here, it would have been a little too refined. We wouldn't have actually tapped into that order block and been entered into this trade. So sometimes it really helps to not over refine things. I've learned that over the years as well, which is why sometimes I'll take entries on the 5-minute instead of the 1-minute. Or if I'm on the 1-minute, maybe I'll target an entire consolidation instead of trying to refine it as tight as possible to one singular candle. That often is like shooting yourself in the foot. You kind of miss the trades that way. So it's really important to not over refine things. So just to continue the recap here, we located the minor break of structure on lower time frames. We targeted this as our new refined demand zone. That trade got triggered, 0 drawdown basically, or very little drawdown. We took off, and when we took off, we created an actual break of structure, which would prompt me to locate this point of interest because that was our refined demand zone that created the break of structure. Price, of course, mitigated that demand zone and then took off once more from there. Now, I'm just noticing this now too, after I've already played price forward. But if you look at what happened right before this break of structure, right? Follow this line over. This candle is the break of structure, right? This one bullish candle is what broke the actual structure, this high over here. What was responsible for that? Well, we have this small bearish indecisional candle right here, and price tapped into it beautifully there as well. So let's drag this over. There could have been another buying opportunity right here. Stop loss just below the candle, another 7 pips. Target the same high. So another 4.44R. So if we add all that together, that's almost 19R within these 3 positions here, within only 9 hours of trading. Okay, so this is really powerful stuff. I hope you guys rewatch this video, take some notes, and really study the entry possibilities within this move, because this is a perfect example of how to utilize the concept of higher time frame mitigation with lower time frame execution. Okay, once more, 15-minute time frame, higher time frame mitigation of this POI, 5-minute time frame, low time frame confirmation entry model. Okay, it could have been used 3 times. 3 times here. I didn't even notice this last one until a minute ago, but this is powerful stuff. You can keep stacking these trades and stacking these trades. As the trades progress, you can of course trail your stop loss. So you could have trailed your stop loss to here. Once price broke through the structure again and created a new solidified low, and then broke that structure again, you could have trailed your stop loss to here. This is new structure here too. You could have trailed your stop loss to here, but there wouldn't be a point because our hard take profit was right there. So this is really powerful stuff, guys. I really want you to rewatch this video as many times as you like and take some notes and really study how these entries were taken, okay? Because this is a perfect example of, like I said, higher time frame mitigation, lower time frame execution. All right, so I hope you guys gained a lot of value from this breakdown, and I will talk to you all soon.